Welcome to vTalkInsight, Market Drivers Daily for July 6th, 2026. After a week dominated by artificial intelligence and energy headlines, markets are now asking whether tech earnings can keep driving equities higher while geopolitical tensions quietly reprice oil, defense, and shipping. We will look at how the AI trade is evolving, how shifting security dynamics affect inflation risk, and why the next phase of the tech-led rally may look very different from the last one. Artificial intelligence remains the central macro and equity driver, but the tone around the theme keeps shifting. Earlier this week, we highlighted that markets were moving from pure capex excitement toward questions about capacity, profitability, and regulation. Today, that evolution is visible in a more selective approach to AI exposure, with investors scrutinizing earnings quality, supply constraints, and how much of the growth story is already reflected in valuations. The upcoming earnings season is set to test AI business models more than the technology itself. Companies are preparing to disclose data on AI token usage, and a slowdown in token purchases could actually be read as positive for software names if it signals more efficient deployment and less fear of AI displacing existing revenue streams. At the same time, rising model usage costs are frustrating many chief executives, encouraging a shift toward narrower, productivity-focused models that demand less compute and may temper the most aggressive data center build-out assumptions. On the hardware side, the AI infrastructure story is powerful but uneven. Nvidia faces significant delays in its next-generation AI servers, with complex circuit board production running more than a year behind, which raises questions about its ability to sustain current demand momentum and creates openings for competitors. Yet AI-related demand remains strong across the stack. Foxconn has reported a 40% profit jump tied to AI hardware. Broadcom has secured a custom chip deal with Apple through 2031, and industrial photonic suppliers like Halma are positioned as key enablers of higher bandwidth, lower latency data centers. Demand for memory and compute remains robust, with limited capex at memory producers suggesting a supply-demand imbalance that could support elevated earnings well into 2028. Capital is flowing aggressively into AI, from a record first half for UK AI venture funding to a sizable US IPO pipeline for data center infrastructure. And credit markets are absorbing heavy issuance from tech and AI borrowers while spreads stay tight. However, pockets of exuberance are clear. Some semiconductor and AI names are trading at extreme valuation multiples. Retail investors are crowding into Korean AI stocks ahead of large listings, and several observers see only a fraction of planned data center projects ultimately being built. For portfolios, this points to an AI theme that still supports earnings upgrades across sectors, but with greater dispersion between durable cash flow stories and areas where expectations and capacity may have run ahead of reality. Setting the stage for our discussion of geopolitics, where AI is also reshaping defense and security spending. Geopolitics continue to impose a structural risk premium, even as some of the acute energy shock we discussed late last week begins to fade. The key tension is that crude prices have eased back toward pre-war levels, and flows through the Strait of Hormuz are gradually recovering. Yet the underlying security backdrop and shipping economics still look very different from a few years ago. That disconnect matters for inflation, central bank policy, and the pricing of energy and transport-exposed assets. In the energy complex, markets are weighing calmer prices against fragile logistics. Attacks, new shipping restrictions, and uncertainty over Iranian control and tolls in the Strait of Hormuz and Red Sea are forcing tankers onto longer routes, while satellite data show traffic through Hormuz still running at roughly one-third of historical norms. OPEC Plus is pressing ahead with planned output increases. Saudi Arabia has cut official selling prices to Asia to defend market share. An alternative or so-called dark shipments are helping stabilize supply, but shipping insurance and tanker rates are likely to remain structurally higher. That keeps a geopolitical component embedded in global freight costs, supporting the case for a slightly higher floor for traded goods inflation than before these tensions intensified. The security picture in Europe and its neighborhood is equally consequential. European NATO members have lifted defense spending to around 2.5% of GDP among the largest economies, up sharply from a decade ago, yet still below the 5% target Washington has floated for 2035, and the United States is signaling potential troop reductions of around 5,000 personnel. On the front line, Ukraine's interceptor missile stocks are critically low, with no ballistic missiles intercepted in the latest Russian strike, pushing Kyiv to seek additional Patriot systems and other air defenses at the upcoming NATO summit. Russia, meanwhile, is escalating sub-threshold activity from sabotage to drone incursions, while global defense budgets on drones, hypersonics, and AI-enabled systems have surpassed $2 trillion, with the United States accounting for the bulk of that total. These dynamics are feeding directly into markets. European defense names, including Italian groups that benefit from a planned €17 billion spending increase, have rallied but remain volatile as debates over burden sharing and European strategic autonomy continue. Industrial names in Asia tied to defense engineering in Korea and Japan are also outperforming, helped by regional rearmament and restructuring. Beyond Europe, bipartisan support in Washington for Taiwan and tighter rules on lobbying for blacklisted Chinese firms underscore a long-running U.S. commitment to constraining China's tech rise, with legal challenges by companies such as Alibaba potentially setting important precedents. Looking ahead, investors are likely to focus on announcements from the NATO summit, any renewed incidents around key maritime chokepoints, and further U.S. legislative moves, all of which intersect with the AI and tech complex that is driving today's equity tape. Turning back to the tape, technology once again sits at the center of equity market direction. U.S. equity futures point to a modest recovery in tech, with Nasdaq futures outperforming as semiconductor and AI-related stocks attempt to extend last week's rebound. The S&P 500 is up roughly 25% year-to-date. The Nasdaq and chipmakers have done even better, and recent sessions have shown how dependent broader index levels remain on a relatively narrow cohort of mega-cap tech and semiconductor names. Within that leadership, the semiconductor and memory segment is crucial. Chip indices have surged, with the Philadelphia Semiconductor Index posting gains of more than 2% on several days, helped by strong moves in Broadcom after it extended its custom chip partnership with Apple through 2031. Memory names are rebounding as well, with companies like SanDisk and Micron recovering sharply from last week's sell-off, supported by expectations that Samsung will raise chip prices again in the third quarter and that SK Hynix's nearly $30 billion U.S. market debut will validate still strong AI-driven memory demand. Limited capex expansion at memory producers and persistent demand from data centers suggest the supply-demand imbalance, and therefore elevated pricing power could persist for several years. Beneath the headline rally, however, positioning inside the tech complex is rotating. Some investors are trimming exposure to highly cyclical semiconductor and Korean hardware names and reallocating towards software and hyperscalers, where holdings have fallen to multi-year lows and business models are seen as more resilient. Analysts arguing that hyperscalers offer a cleaner way to play AI than chipmakers are gaining traction, and there is an expectation that leadership could rotate back toward platforms like Amazon and Microsoft, whose shares have lagged some chip peers despite expectations for strong second-half AI-driven earnings contributions. At the same time, small caps and more traditional sectors continue to lag, reinforcing the sense of a narrow, tech-dominated advance. Valuation and flow dynamics are the main risks to this tech-led rally. Some prominent AI and semiconductor stocks are viewed as having run ahead of fundamentals, with valuation multiples approaching levels last seen near the peak of prior tech cycles, and retail-driven enthusiasm in Korean AI shares contrasts with institutional profit taking and a downsized SK Hynix depository receipt deal. There are also signs that recent moves have been amplified by technical factors, such as short gamma positioning, which can unwind quickly if earnings disappoint. That puts significant weight on upcoming catalysts, from Samsung results and SK Hynix's listing to guidance from U.S. hyperscalers and AI software leaders, to confirm whether current growth expectations are realistic. For now, strong balance sheets, ongoing earnings upgrades, and open credit and IPO markets continue to underpin the tech trade, but with much less room for error as we move through the second half of the year. To wrap up, AI remains the dominant engine of global growth narratives, but the conversation is shifting away from blanket optimism toward careful analysis of earnings quality, supply bottlenecks, and where valuation risk is most acute. Geopolitical tensions are embedding a structural premium into energy, shipping, and defense, even as spot oil prices look calm, with NATO spending choices and maritime security likely to influence both inflation paths and sector leadership. On the equity side, the tech-led rally is intact but narrower, with semiconductors and a handful of platforms carrying much of the load, leaving indexes sensitive to any disappointment from upcoming chip and megacap earnings. Staying attuned to how AI guidance, defense commitments, and energy logistics evolve over the next few weeks will be critical for understanding where risk and resilience are building across asset classes. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.